On October 11, 2019, the Securities and Exchange Commission filed an emergency action in the United States District Court for the Southern District of New York. The target was not some obscure crypto startup operating out of a basement. It was Telegram, one of the largest messaging platforms on the planet, used by hundreds of millions of people worldwide. The SEC alleged that Telegram had conducted a massive unregistered digital token offering, raising $1.7 billion from investors in what regulators described as an illegal securities sale. At projected launch valuations, the total value of the token supply in question was estimated to exceed $5 billion. And with just hours remaining before those tokens were set to flood the open market, federal regulators moved to block the entire distribution. The question at the center of it all was deceptively simple. Had one of the world's most prominent technology companies just attempted the largest illegal securities offering in cryptocurrency history? To understand how this happened, you have to go back to the origins of Telegram itself. Telegram was founded in 2013 by Pavel Durov and his brother Nikolai. Pavel Durov was already well known in the tech world. He had previously created VKontakte, the most popular social network in Russia, before being forced out of the company under political pressure from the Russian government. He left Russia, became a self-described digital nomad, and launched Telegram as a secure encrypted messaging platform built around a philosophy of privacy and independence from government surveillance. By 2017, Telegram had grown rapidly, reaching more than 200 million monthly active users across the globe. But Telegram had a problem that few outsiders fully appreciated. Despite its massive user base, the company had no clear revenue model. It didn't run advertisements, it didn't sell user data, it didn't charge subscription fees. Pavel Durov had personally funded a significant portion of the operation, but sustaining a platform at that scale without monetization was becoming increasingly difficult. Then, in late 2017, Durov and his team identified what appeared to be the perfect solution. The cryptocurrency boom was reaching a fever pitch. Initial coin offerings, known as ICOs, had exploded in popularity, allowing technology projects to raise hundreds of millions of dollars by selling digital tokens to investors before a product even existed. In 2017 alone, ICOs raised an estimated $6 billion globally, according to industry tracking data. Most of the projects behind those offerings had no real user base, no proven product, and no meaningful technology. Telegram had all three, or at least it had the user base and the brand recognition. In early 2018, Telegram announced its plans for the Telegram Open Network, known as TON. The vision was staggeringly ambitious. TON would be a next-generation blockchain platform capable of processing millions of transactions per second, far outpacing existing networks like Bitcoin and Ethereum. It would feature decentralized storage, integrated proxy services, a payment infrastructure, and direct integration into the Telegram messaging application. At the center of it all was a native digital token called Gram. Gram would serve as the primary currency of the entire TON ecosystem, used for transactions, smart contracts, decentralized applications, and peer-to-peer payments. According to Telegram's detailed technical white paper, TON would ultimately form the backbone of a new decentralized internet, all powered by Telegram's enormous and rapidly growing global user base. The pitch was compelling, and investors responded with extraordinary speed. In January 2018, Telegram launched the first round of its Gram token sale. This was not a public ICO. It was a private offering, restricted to accredited investors and institutional funds, structured under Regulation D of the Securities Act. Telegram sold Gram tokens through instruments called Gram purchase agreements, contracts granting buyers the right to receive tokens once the TON blockchain officially launched. According to SEC filings, in that first round, 81 investors committed a total of approximately $850 million. The price per token was set at roughly 0.38. Just 2 months later, in March 2018, Telegram launched a second round. This time, 94 additional investors participated, but the price had jumped dramatically to approximately 1.33 per Gram token. That represented a 250% increase in less than 60 days, despite the fact that no blockchain had been built, no token had been distributed, and no network was operational. The second round raised another $850 million. Combined, according to SEC records, Telegram had raised approximately $1.7 billion from roughly 175 purchasers, making it the largest token offering in history at that time. The investor roster read like a who's who of global venture capital and institutional finance. According to reports and regulatory filings, participants included major venture capital firms, hedge funds, family offices, and entities linked to sovereign wealth. The enthusiasm was immense. Some investors reportedly attempted to increase their allocations and were turned away because the offering was oversubscribed. From the outside, everything about this deal projected strength, credibility, and momentum. Telegram had a real product with a massive user base that was still growing. The Durov brothers had a proven track record in building large-scale technology platforms. The TON white paper was technically detailed and appeared to present a legitimate and sophisticated engineering vision. And the fundraising itself was conducted through private placements, with Form D notices filed with the SEC, suggesting at least a surface-level awareness of regulatory compliance requirements. But beneath this veneer of legitimacy, there were early signals that something was structurally wrong. First, there was the secrecy. Telegram imposed strict confidentiality requirements on all participants. The white paper was not publicly released by the company. It was leaked by third parties and circulated through investor networks and crypto forums. For a project that claimed to be building an open, decentralized network for the world, the development process was remarkably opaque. Second, there was the pricing structure. The leap from 0.38 to 133 per token between the two rounds, with no product milestones achieved in the interim, raised serious questions about whether the valuation was driven by fundamentals or by speculative momentum and investor FOMO. Third, there was the team. According to available information, the core TON development team consisted of roughly a dozen engineers, building a blockchain platform capable of millions of transactions per second, essentially outperforming Visa's entire global payment network, with a team that small was, by any standard, an extraordinary technical ambition. And then there was the most critical factor of all, the deadline. Telegram had committed in its Gram purchase agreements to launch the TON network and distribute Gram tokens to investors by no later than October 31st, 2019. If it failed to meet that deadline, the company would be obligated to return the invested funds. That clock was now ticking, and as 2018 turned into 2019, the broader cryptocurrency market collapsed around them. Bitcoin lost more than 80% of its value from its all-time high. Hundreds of ICO-funded projects went bankrupt, disappeared, or were sued by regulators. Scrutiny of token offerings intensified sharply across the SEC, CFTC, and state-level regulators. Yet Telegram pressed forward, still holding $1.7 billion in investor capital, still building TON in near-total secrecy, and still aiming for that October 2019 launch deadline. What investors didn't yet know, and what regulators were already beginning to examine, was that the legal architecture of the Gram offering itself contained a fundamental structural flaw, one that would ultimately bring the entire $5 billion vision crashing down. The structural flaw was not hidden in the technology. It was embedded in the legal and economic design of the Gram token itself. And once regulators dissected it, the entire offering unraveled. According to the SEC's complaint filed in October 2019, the core issue came down to a single legal determination: whether Gram tokens were securities. Telegram had structured the sale as a private placement under Regulation D, which allows companies to sell securities to accredited investors without registering them with the SEC. But Regulation D comes with strict limitations. And most critically, the securities sold under Regulation D cannot be immediately resold to the general public without registration or an applicable exemption. And this is where the mechanism broke down. The Gram purchase agreements entitled investors to receive Gram tokens once the TON blockchain launched. But those tokens were not restricted. They were not locked up. they were not subject to holding periods. According to SEC filings, the moment the TON network went live, investors would be free to immediately sell their Gram tokens on public cryptocurrency exchanges to anyone, retail buyers, day traders, speculators, without any limitation whatsoever. The SEC argued that this was not merely a secondary market developing organically. It was, according to the complaint, the entire economic logic of the offering from the start. Investigators alleged that the initial purchasers had not bought Grams to use them as a currency or utility token within the TON ecosystem. They had bought them with a reasonable expectation of profit, driven by the anticipated increase in value once millions of Telegram users gained access to the tokens on public markets. In other words, the SEC contended that the Gram purchase agreements and the subsequent token distribution were two steps in a single integrated transaction. And that single transaction constituted an unregistered public securities offering. This distinction was critical. It transformed the entire deal from a compliant private placement into what regulators characterized as a violation of Section 5 of the Securities Act of 1933. To fully understand the incentive structure, you have to follow the money. The initial round investors paid roughly 0.38 per gram. The second round investors paid roughly 1.33 per gram. According to regulatory filings and court documents, both groups would receive their tokens simultaneously upon network launch. That meant first-round investors were sitting on paper gains of more than 250% before the blockchain even went live. And both groups anticipated further gains once the tokens hit the open market and became accessible to Telegram's hundreds of millions of users. The SEC's analysis alleged that investors understood this dynamic clearly. Court documents indicated that internal Telegram communications and investor-facing materials emphasized the growth potential of Gram tokens tied to the expansion of the Telegram user base. According to the SEC, some purchasers were entities that had explicitly stated their intent to distribute tokens through downstream sales channels. The regulator argued that these were not passive holders. They were, in effect, underwriters in a disguised public distribution. While the legal architecture carried this embedded risk, Telegram continued developing the TON platform through 2018 and into 2019. The company released periodic updates to investors, published additional technical documentation, and conducted private testing of the blockchain network. But external observers had limited visibility into actual development progress. The project operated with minimal public transparency, unusual even by cryptocurrency industry standards, where open-source development and public testnets were common practice. In April 2019, Telegram launched a limited testnet, a testing version of the TON blockchain, allowing external developers to begin experimenting with the network. Some in the crypto community viewed this as a positive signal. But by this point, the broader regulatory environment had shifted dramatically. Throughout 2018 and 2019, the SEC had been systematically targeting ICOs and token offerings that it deemed to be unregistered securities sales. The agency brought enforcement actions against dozens of projects, ranging from small startups to multi-hundred-million-dollar offerings. In June 2019, the SEC reached a $24 million settlement with Block 1 over its EOS token offering, which had raised $4 billion. In September 2019, the agency settled with the messaging app Kik for $5 million over its Kin token sale, which had raised approximately $100 million. The regulatory trend was unmistakable. The SEC was drawing a firm line that most token offerings constituted securities offerings, regardless of how the projects labeled them. And Telegram, with its $1.7 billion raise, was by far the largest target still standing. According to public reporting, the SEC had been investigating Telegram's offering since at least early 2019. The agency issued subpoenas to multiple Gram purchasers, seeking details about the terms of their investments, their communications with Telegram, and their intentions regarding resale. Yet Telegram continued to move toward its October 31st launch deadline. Then, on October 11, 2019, just 20 days before the scheduled token distribution, the SEC struck. The Commission filed an emergency complaint in the Southern District of New York, seeking a temporary restraining order to block the distribution of Gram tokens. The complaint named two entities, Telegram Group Inc. and TON Issuer Inc., and alleged that the defendants had conducted an illegal, unregistered securities offering. According to the filing, the SEC argued that allowing the distribution to proceed would result in immediate and irreparable harm, as billions of tokens flooded into public markets without any of the investor protections required by federal securities law. The court granted the temporary restraining order the same day. The Gram distribution was frozen. Telegram pushed back. Hard. The company's legal team, led by prominent attorneys, argued that Gram tokens were not securities. They contended that Grams were a cryptocurrency, a medium of exchange, functionally similar to Bitcoin or Ether, neither of which the SEC had classified as a security. Telegram argued that the Gram purchase agreements were securities, which is why they had been sold under Regulation D. But the tokens themselves, the company maintained, were a separate product, a functional digital currency that would operate within the decentralized TON ecosystem. Once delivered to purchasers, Telegram argued, the Grams would function as utility tokens, used to pay for services, execute smart contracts, and conduct transactions on the network. They were not investment contracts. They were commodities. Also, the defense maintained. The legal battle escalated rapidly. In January 2020, the court converted the temporary restraining order into a preliminary injunction, keeping the token distribution blocked while the case proceeded. Both sides filed extensive briefs. The SEC submitted detailed economic analysis. Telegram submitted technical declarations about the TON network's functionality. The case became the most closely watched digital asset enforcement action in U.S. history. During the proceedings, critical details emerged from discovery and court filings that further complicated Telegram's position. According to documents reviewed by the court, Telegram had spent approximately $400 million of the $1.7 billion raised, much of it on developing the TON blockchain, but a meaningful portion on Telegram's general operational expenses, including server infrastructure and employee costs. This raised additional questions about the separation between the token project and the messaging platform. If investor funds raised for the TON blockchain were being used to sustain Telegram's broader operations, it reinforced the SEC's argument that purchasers were investing in the overall Telegram enterprise, not simply pre-purchasing a functional currency. Court documents also revealed that Telegram had offered certain investors enhanced terms, including discounted pricing and bonus allocations, to incentivize larger commitments. According to SEC filings, these arrangements further supported the characterization of Grams as investment instruments rather than utility tokens. Meanwhile, the October 31, 2019 deadline passed without a launch. Under the terms of the Gram purchase agreements, Telegram was now technically in breach of its contractual obligations to investors. To avoid triggering mandatory refund provisions, the company sought and obtained consent from a majority of purchasers to extend the deadline to April 30, 2020. Most investors agreed. They had committed enormous sums and had strong financial incentives to allow Telegram more time rather than demand immediate repayment. But the extension only deepened the regulatory problem. The SEC argued that the deadline extension itself demonstrated that purchasers were acting as investors, managing their economic exposure, weighing risk and return, and making decisions based on the expected future profitability of the Gram tokens. This was not how users of a currency behave. This was how investors in a speculative asset behave, and the court appeared to agree. On March 24, 2020, Judge P. Kevin Castell of the Southern District of New York issued a ruling that would reshape the digital asset landscape. In a detailed 46-page opinion, the court sided decisively with the SEC. Judge Castell found that the Gram purchase agreements and the planned token distribution constituted a single integrated scheme to distribute securities to the public without a valid registration statement. The court rejected Telegram's argument that the tokens and the purchase agreements should be treated as separate transactions. According to the ruling, the economic realities of the transaction, the discount pricing, the expectation of profit, the planned public resale, meant that the entire arrangement was an investment contract under the Howey test. The Howey test, established by the Supreme Court in 1946, defines an investment contract as a transaction where money is invested in a common enterprise with the expectation of profits derived from the efforts of others. Judge Castell found that all elements of the Howey test were satisfied. The preliminary injunction was upheld. The Graham distribution remained blocked, and Telegram was now facing the prospect of unwinding one of the largest fundraising events in technology history. The company had $1.7 billion in investor capital. It had spent hundreds of millions. It had no path to launching its token, and the legal and financial consequences were only beginning. The ruling left Telegram with no viable path forward. Judge Castell's opinion had not merely blocked the Graham distribution, it had fundamentally rejected the legal theory upon which the entire $1.7 billion offering was constructed. Telegram could appeal, but an appeal would take months, possibly years, and the company was already past its contractual deadline to deliver tokens to investors. The financial pressure was immense. According to court filings, Telegram had already spent a significant portion of the funds raised, an estimated $400 million or more, on TON development and Telegram operational costs. If the company was forced to return the full $1.7 billion immediately, it would face a massive shortfall. And the investors who had committed those funds, sophisticated institutions, venture capital firms, and high net worth individuals, were now staring at the possibility that their money was locked inside a project that might never launch. On May 12, 2020, Pavel Durov made the announcement many had feared. In a public message posted to his Telegram channel, Durov declared that Telegram was abandoning the TON project entirely. He described the situation with visible frustration, writing that a US court had prevented the TON network from launching globally, not just in the United States, because Graham tokens could potentially reach American buyers through secondary markets. Durov characterized the ruling as a decision by a single country's court system to effectively block a global technology project. But frustration aside, the legal reality was clear. Telegram could not distribute Graham tokens without violating a federal court order. And without token distribution, the TON ecosystem had no functional economic layer. The project was dead. 1 month later, the financial reckoning arrived. On June 26, 2020, the SEC announced that Telegram had agreed to settle the case. According to the settlement, Telegram consented to return approximately $1.2 billion to investors. The company also agreed to pay an $18.5 million civil monetary penalty to the SEC. And Telegram was required to provide the Commission with 45 days advance notice before participating in any future digital asset offerings for a period of 3 years. The settlement did not include an admission or denial of wrongdoing by Telegram, a standard feature of SEC consent agreements. But the financial terms spoke for themselves. Telegram had raised $1.7 billion. It had spent hundreds of millions, and now it was obligated to return $1.2 billion while absorbing an additional penalty. According to public reporting, Telegram arranged loans from investors to fund the repayments, effectively restructuring its obligations into debt rather than equity. The company survived, but the cost was staggering. For investors, the outcome was a painful lesson in regulatory risk. Many had entered the deal believing they were participating in the most promising token offering in cryptocurrency history, backed by a real product, a proven founder, and a user base of hundreds of millions. They had conducted due diligence. They had reviewed legal structures. They had signed agreements that appeared compliant with US securities regulations. And yet the fundamental legal question, whether Graham tokens were securities, had never been definitively resolved before the money changed hands. According to reports, some investors received their refunds in full or near full. Others, particularly those who had purchased through intermediaries or secondary arrangements, faced more complicated recovery paths. The precise breakdown of investor losses versus recoveries was never fully disclosed publicly. But the broader damage was not limited to direct financial losses. The Telegram case sent shockwaves through the cryptocurrency industry and the venture capital ecosystem that funded it. For years, token issuers had operated in what many described as a regulatory gray zone. The SEC had issued guidance. It had brought enforcement actions against smaller projects. It had published frameworks for analyzing whether a digital asset was a security. But the Telegram ruling was different. It was the first time a federal court had issued a detailed, reasoned legal opinion, blocking a major token distribution on securities law grounds, and done so against one of the most well-resourced and legally sophisticated defendants in the space. The ruling established several principles that reshaped industry practices going forward. First, it confirmed that the economic reality of a transaction, not its label, determines whether it constitutes a securities offering. Calling a token a currency or a utility does not exempt it from securities regulation if the underlying economic structure resembles an investment contract. Second, it established that a token sale structured as a private placement cannot serve as a pipeline to unrestricted public distribution. The court treated the private sale and the planned public distribution as a single integrated transaction, collapsing the legal separation that Telegram had relied upon. Third, the ruling demonstrated that US courts were willing to assert jurisdiction over global token distributions if there was a reasonable likelihood that tokens would reach American investors, even through secondary markets. This had enormous implications for non-US projects that had previously assumed they could avoid SEC oversight by excluding American buyers from initial sales. The systemic effects rippled outward quickly. According to industry analysis, the volume of large-scale token offerings declined sharply following the Telegram ruling and settlement. Projects that had been planning similar structures paused, restructured, or abandoned their offerings entirely. Legal counsel across the cryptocurrency industry began advising clients to treat virtually all token sales as potential securities offerings and to seek registration or clear exemptions before proceeding. The ruling also intensified the broader policy debate about how digital assets should be regulated in the United States. Industry advocates argued that the existing securities framework was ill-suited to govern decentralized networks and functional digital currencies. Regulators maintained that investor protection principles applied regardless of the technology involved. The tension remains unresolved to this day. In an unexpected epilogue, the TON technology did not disappear entirely. After Telegram abandoned the project, independent developers, unaffiliated with the company, forked the open-source TON code and launched their own version of the network. This community-driven project eventually became known as the Open Network, retaining the TON acronym, and its associated token, TONcoin, began trading on cryptocurrency exchanges. Telegram itself later integrated certain TON-based features into its platform, including a crypto wallet and payment functionality, though the company maintained that it was not directly operating the blockchain network. According to public statements, Telegram positioned these integrations as third-party services rather than proprietary products. The legal and regulatory boundaries of this relationship remain a subject of ongoing scrutiny. Pavel Durov continued to lead Telegram, which eventually introduced premium subscription services and advertising revenue streams, the conventional monetization strategies that the TON project had originally been designed to circumvent. The Telegram case is significant not because it involved outright fraud in the traditional sense. There were no fabricated financial statements. There was no Ponzi structure. There were no allegations of personal enrichment through embezzlement or misappropriation. What made this case distinctive, and what makes it essential to understand, is that it demonstrated how a fundamentally flawed legal architecture can destroy billions of dollars in value even when the underlying product is real and the participants are sophisticated. Telegram built a legitimate technology platform used by hundreds of millions of people. The Durov brothers had genuine technical credentials and a real engineering vision. The investors were not unsophisticated retail buyers chasing hype. They were accredited institutions with legal teams and due diligence processes, and yet the offering collapsed because the core structure, selling tokens privately with the expectation that they would immediately trade publicly, violated the most basic principle of US securities law, that public distributions of investment instruments require registration and disclosure. The lesson is not that cryptocurrency is inherently fraudulent. It is not. The lesson is that innovation does not exempt a financial instrument from the legal frameworks designed to protect investors and maintain market integrity. The Telegram case demonstrated that regulatory risk is not theoretical. It is not a distant possibility that can be managed with clever legal structuring. It is a concrete, enforceable constraint, one that can unwind billions of dollars in capital, block the launch of globally anticipated products, and reshape entire industries overnight. For investors, the case is a reminder that the sophistication of a project, the reputation of its founders, and the quality of its technology do not eliminate structural legal risk. For builders, it is a reminder that regulatory compliance is not an obstacle to innovation. It is the foundation upon which sustainable innovation is built. And for the broader financial system, the Telegram case stands as one of the most consequential enforcement actions of the digital asset era. A case that drew a clear, court-tested line between legitimate fundraising and illegal securities distribution. The $1.7 billion was raised in weeks. The legal battle lasted over a year, and the consequences will shape digital asset regulation for decades.